All right, so let's dive into this. LIC Housing Finance Q3 2025 performance. We've got Gary, and we've got the regulatory filing here, financial statements, auditor reports, even an investor presentation. We're going to unpack all of it today.
Yeah, it's a gold mine of information.
Yeah,
Um,
yeah,
Not just the numbers, of course, but what they tell us about LIC Housing Finance's strategy
yeah,
and how they're navigating the Indian housing market.
yeah. To set the stage, LIC Housing Finance is a major player, right? They crossed R's. 4,000 crore in profit last year, history of strong growth. They even hit up a milestone, R's 2,050,000 crore in assets back in 2022. But beyond just the raw numbers, they've also received recognition for their corporate social responsibility initiatives. And
And for being a great workplace for women.
that's an interesting point. I mean, while financial performance is crucial, a company's commitment to social responsibility and a positive work environment can really speak volumes about their long-term sustainability and value. Absolutely. Now let's get into the heart of Q3 2025. Their profit after tax jumped a significant 23% year over year, reaching R's 1,431.96 crore. That's a pretty big leap.
It is. But let's not get ahead of ourselves. While profit is up, revenue from operations only saw a modest 4% rise. To R's 7,057 crore. This suggests that the drivers behind their profitability might be shifting, and we need to understand why.
Okay, so digging a bit deeper. Their loan portfolio expanded by a solid 6%, reaching R's 2,099,144 crore. But here's something that caught my eye. They actually sold off a stressed asset through an asset reconstruction company for R of 250 crore in cash. It makes you wonder, is this a sign of a new risk management approach?
It certainly raises questions. Selling a stressed asset can be a way to free up capital and reduce risk. But it's important to understand the circumstances behind this particular sale and whether it points to a broader shift in their risk management strategy.
And while we're on the topic of loans, it's worth noting that overall loan disbursements only inched up by 2% to R's 15,475 crore. More specifically, individual home loan disbursements actually went down at.
That's definitely something to watch. Is this a temporary blip? Or a sign of a cooling housing market? Or maybe they're facing increased competition from other lenders? We need more context to fully understand this trend.
And to complicate matters further, their net interest margin, essentially the difference between what they earn from loans and what they pay for funds, shrank to 2.70% from 3.00% in the same quarter last year. That's not exactly a great sign, right?
Not necessarily. A shrinking margin could be due to several factors. For example, their borrowing costs might be rising, or they might be facing pressure to keep interest rates low for borrowers. In a competitive market, we need to look at their funding sources and lending practices to get the full picture.
So let's talk about funding. Their investor presentation shows that over the past 4 years, they've been shifting away from traditional bank loans and relying more on non-convertible debentures or NCDs.
Now, for those who aren't familiar with NCDs, these are essentially debt instruments the companies issue to raise capital. They're different from traditional bank loans in a few ways. And this shift toward NCDs could have both advantages and disadvantages for LIC Housing Finance.
So break it down for us. What are the pros and cons of this strategy?
Well, one potential upside is that NCDs can offer more flexibility in terms of repayment schedules and interest rates. They can also be a cheaper source of funding compared to bank loans.
Yeah.
However, there are risks involved as well. NCDs can expose a company to interest rate volatility. If interest rates rise, as they have been globally, the cost of servicing those NCDs goes up.
And that could squeeze their margins even further.
Exactly. It's a delicate balancing act. They're trying to secure funding at the best possible rates while navigating a changing interest rate environment.
And to make things even more interesting, they've also been expanding their footprint beyond the major cities. Their investor presentation highlights growing contributions from other regions, and they even have representative offices in Dubai.
This suggests a strategic move to diversify their portfolio by tapping into a wider range of markets. They're less reliant on the performance of a few major urban centers. It's a way to spread risk and potentially access new growth opportunities.
Now, for those of you listening who might be thinking about getting a home loan or investing in LIC Housing Finance, how can we connect all these dots? What should you be paying attention to?
If you're considering a home loan from LIC Housing Finance, you'll want to look closely at their portfolio statistics. Things like their average loan-to-value ratio.
Hold on, let's break that down. The loan-to-value ratio is basically how much of the property's value is covered by the loan. A higher ratio means you're putting down less of your own money up front.
Right. You'll also want to consider their average installment net income ratio, which tells you what percentage of a borrower's income is going towards their mortgage payments. And don't forget about prepayment trends, as these can impact a lender's profitability and your potential costs as a borrower.
And if you're looking at LIC Housing Finance as an investment,
Then you'll want to compare their financial performance, things like their return on equity and capital adequacy ratio, to other players in the housing finance sector. This will give you a sense of how they stack up against the competition.
so we've covered a lot of ground here, but we're just getting started. There are still so many fascinating details to explore in their investor presentation, including a breakdown of their loan portfolio, their risk management practices, and their future outlook.
And we'll dig into all of that in the next part of our deep dive.
Welcome back to our deep dive into LIC Housing Finance. Before we jump into the next layer of their Q3 2025 performance, I want to remind you that this deep dive is just the beginning. There's a treasure trove of information on their investor relations website, financial reports, presentations, all the juicy details. Don't just take our word for it. Explore and come to your own conclusions.
Exactly. Do your own due diligence. Dig into those resources and see what insights you can uncover.
Okay, back to the numbers. We were talking about their net interest margin shrinking. Looking closer at their investor presentation, we see their weighted average cost of funds actually increased slightly to 7.78%. It's not a huge jump, but as we all know, every bit counts.
Especially in a business where margins are already tight. And it's not just about the cost of funds. Their yield on advances, basically the interest they're earning on their loans, also dips slightly from 9.97% to 9.73%. This suggests they might be facing some headwinds in passing on those increased borrowing costs to their customers.
We've got potential slowdown in demand, competition heating up, shrinking margins. Could this be a sign of a bigger shift happening in the Indian housing finance market?
It's certainly a possibility worth considering. And with interest rates on the rise globally, the landscape for housing finance companies is likely to get even more complex. The question is, how will LIC Housing Finance navigate these challenges and maintain their growth trajectory?
It's a good question. But let's not forget about LIC Housing Finance's strengths. Remember that extensive network of branches and marketing channels they've built? That gives them a massive reach, especially in those underserved markets they're targeting.
Absolutely. And their brand recognition is a major asset. They've built a reputation. Over decades in the Indian market, when people are looking for a financial partner, that kind of trust and stability can be a deciding factor.
Plus, there's a connection with LIC, the giant of the Indian insurance industry. That relationship opens doors to capital and creates some interesting cross-selling opportunities.
Now, shifting gears a bit, their investor presentation reveals some intriguing details about their individual loan portfolio. For example, the average loan-to-value ratio, remember that's the size of the loan compared to the property value, has been creeping up. In Q3 2025, it hit 51%, compared to 47% back in fiscal 2023.
So for those who might not be finance experts, a higher loan-to-value ratio means the borrower is putting down less of their own money up front. That can make homeownership more accessible, but it also increases the lender's risk.
Exactly if the market takes a dip and property values drop. Those borrowers could find themselves owing more on their mortgage than their home is worth. That's a recipe for defaults and financial stress for everyone involved.
That makes sense. So while LIC Housing Finance's decision to bump up that average loan-to-value ratio might be a play to stay competitive and attract more borrowers, it's a strategy that needs a close watch, especially in a market that's showing some signs of softening.
Agreed. And here's another point to consider. The proportion of floating rate loans in their portfolio has been steadily increasing, reaching 99% in Q3 2025.
Okay, so in plain English, this means almost all their borrowers have mortgages, with interest rates that go up and down with the market. If rates continue to climb, as we've been seeing,
Those monthly payments will likely get bigger, potentially putting a strain on borrowers' budgets and increasing the risk of defaults.
that's a sobering thought. It highlights the importance of another metric we mentioned earlier, the installment to net income ratio. This basically measures how much of a borrower's income goes towards their mortgage payment.
The higher that ratio, the greater the chance the borrower might struggle to make their payments. And LIC Housing Finance's investor presentation shows that this ratio has also been ticking upwards, reaching 31% in the first 9 months of fiscal 2025.
That does seem a bit high. It suggests a good chunk of their borrowers might be financially stretched, especially if those interest rates keep going up.
It's a definite point of consideration. And remember those prepayment trends we touched on earlier? Well, their investor presentation shows that lump sum prepayments and prepayments from the opening book have been around 9–10% in recent years.
That's not a small number. Prepayments, while good for borrowers who want to pay off their loans faster, can actually impact a lender's profitability. It disrupts the expected flow of interest income they were counting on.
Yes.
Exactly. Think of it like getting your money back from an investment earlier than planned. You might be happy to have the cash, but you miss out on some of the potential earnings you were expecting. While LIC Housing Finance's prepayment rates aren't setting off alarm bells just yet, they're definitely something for investors to keep in mind, especially if they're combined with other trends, like those rising defaults we discussed.
So as we peel back these layers of LIC Housing Finance's performance, we're seeing this intricate web of factors, both positive and potentially challenging.
It's like piecing together a puzzle, right? But even with all this data, some pieces are still missing.
You're right. We've been focusing so much on those individual home loans, we almost forgot about the other parts of their business, those subsidiaries they have, involved in everything from financial services to asset management and even senior living communities. That's a great point. What's the story there? Are these subsidiaries contributing significantly to LIC Housing Finance's overall performance? Do they bring diversification, reducing their reliance on the ups and downs of the housing market? Or are they facing their own unique challenges?
We've only scratched the surface in this deep dive, and that's the beauty of it, isn't it? There's always more to learn, more connections to make, more insights to uncover.
Absolutely. And we'll explore some of these unanswered questions in the final part of our deep dive.
So we were just talking about LIC Housing Finance's subsidiaries and how those businesses fit into the bigger picture. It's easy to get caught up in the details of their core lending operation, but those other ventures could be a key part of their story.
Yeah, absolutely. Diversification can be a powerful strategy, especially in a sector as cyclical as housing finance. If those subsidiaries are performing well, they could provide a buffer against fluctuations in the core business. It's like having multiple engines on a plane, right? Even if one sputters a bit, the others can keep you airborne.
Makes sense. But remember how we talked about them expanding their footprint, especially in those less served regions? Their investor presentation highlights their efforts to build this vast network of offices and marketing channels.
Yeah, it's not just about bricks and mortar, though. They're leveraging a variety of channels to reach potential customers. Home loan agents, direct sales agents, customer relations associates, and even their own direct marketing force. It's a multi-pronged approach, and it seems to be working, at least in terms of expanding their reach.
But reach alone doesn't tell the whole story. We have to consider the quality of those loans they're making, right? That's where those portfolio statistics we discussed earlier become really critical.
Precisely. Those rising loan-to-value ratios and installment-to-net income ratios, coupled with the shift towards floating-rate loans, suggest LIC Housing Finance might be taking on more risk to fuel that growth. Now, whether that's a good or bad thing depends on a bunch of factors. The overall health of the Indian economy, how stable the housing market is, and how effective LIC Housing Finance's risk management practices are.
It's a balancing act, isn't it? And with all the uncertainty in the global economy, it's no surprise that investors are laser-focused on every bit of data, every trend, every little signal.
That's the name of the game. We're all trying to make sense of a complex and constantly changing world. And sometimes the most valuable insights come from looking beyond the obvious, from connecting seemingly unrelated bits of information, and from asking the right questions.
Which is exactly what we try to do here on The Deep Dive. We've taken you on a journey through LIC Housing Finance's Q3 2025 performance, explored the numbers, their strategies, the potential risks and rewards. We've given you the tools to start your own exploration and form your own opinions.
Now it's up to you to decide what you think about LIC Housing Finance. Is it a company you'd want to invest in, borrow from, or simply keep an eye on?
So until our next deep dive, stay curious, keep those questions coming, and remember, knowledge is power.